Hi, I'm Dong Shong. Welcome to Dig into China, where we explore China in depth to review unique perspectives. In this video, we are diving into China's huge trade and investment surpluses in recent years that seem to have disappeared without a trace. The data for 2023 and 2024 has come in, and this massive surplus is nowhere to be found, even though it totals an incredible $3.2 trillion. To put it into perspective, that's the equivalent of 2 years' worth of total US real estate sales. No financial institution could hide such huge amounts of foreign exchange. This is an issue worth investigating. So let's break down the mystery of China's missing foreign exchange. Let's start with the biggest source of foreign exchange data, which consists of 3 sets of figures. First, we have data from the State Administration of Foreign Exchange on China's service trade imports and exports. For years, China's service trade has been in a deficit, meaning it's been a net outflow of foreign exchange. This is because fewer foreigners are coming to China for tourism, but Chinese citizens are spending a lot abroad, whether traveling or paying for education overseas. From 2020 to 2024, this service trade deficit totaled $790 billion. Next, we have customs data on goods imports and exports. China is the world's largest exporter of goods, which has led to a massive trade surplus. From 2020 to 2024, China's goods trade surplus totaled $3.9 trillion. Together, these two trade categories created a total surplus of $3.12 trillion over the past 5 years. The third data set comes from the Ministry of Commerce, which tracks foreign direct investment in China, essentially the foreign exchange China has received. It also shows China's outward investments, money China has spent overseas. The difference between these two figures represents the net foreign exchange China earned through investments. From 2020 to 2024, all years were positive except 2024, meaning China earned less foreign exchange from investments than it spent. The total for these 5 years was $120 billion. Now, adding everything up, the $3.12 trillion surplus from trade plus the $120 billion from investments gives us a total of $3.24 trillion. But here's the catch. This $3.24 trillion seems to have vanished. It's nowhere to be found in China's financial records. It's almost as if it's completely disappeared. It's important to note that there's no way this $3.24 trillion is being hidden as cash in some secret vault. It must exist electronically in some financial account, and it would be impossible to hide in the data. So no financial institution would dare cover up such a large sum of money. So let's take a closer look at whether China's foreign exchange data has been growing in recent years. We'll start with banking data. When foreign exchange flows into China's central bank, the People's Bank of China, it becomes part of the foreign exchange reserves. If it goes into commercial banks, it becomes foreign exchange deposits. These amounts are strictly recorded. The central bank publishes monthly data, and most commercial banks listed on the stock market report their data quarterly, so we can cross-check it. At the end of 2019, the total foreign exchange, combining reserves and commercial banks' deposits, was $38.68 trillion. This represents the foreign exchange in China at the time, because almost all foreign exchange in China is either in the central bank's accounts or commercial banks. By the end of 2024, this total had increased to $40.55 trillion, an increase of just $187 billion from the end of 2019. Given the $3.24 trillion in trade and investment surplus accumulated over 5 years, this increase is tiny, almost negligible. To emphasize again, there's no way this $3.24 trillion of surplus and investment income is hidden as cash in some underground vault. China's foreign trade and foreign investment follow two strict rules. First, all financial transactions are electronic, with clear regulations. Cash settlements are rare and it requires special approval. No business would go through the trouble of applying for this approval, as it would raise red flags for money laundering. Anyone trying to apply for such approval would be immediately arrested. It's essentially a trap. So, this $3.24 trillion must exist in some financial account. It's impossible for it to disappear. That's the first rule. The second rule is the 120-day rule, which requires foreign exchange to be returned to China within 120 days. Most businesses must settle foreign exchange within 90 days after a transaction. If it's sent to an overseas account, it must be brought back to a designated domestic account within 30 days. That makes it a strict 120-day rule. If foreign exchange isn't returned within that time frame, the State Administration of Foreign Exchange will step in. To break the 120-day rule and keep foreign exchange abroad for longer, businesses must apply for special approval from the Foreign Exchange Bureau, offering legitimate reasons like needing raw materials or making investments overseas. But getting this approval is very difficult, and only a small number of businesses are able to do so. Let's wrap this up. Given the strict rules surrounding foreign exchange in China, like the electronic settlement and the 120-day repatriation rule, it's impossible for companies to bypass these regulations on a large scale. From 2020 to 2024, the $3.24 trillion surplus and net investment flow should have been clearly reflected in the foreign exchange data, either in the central bank's reserves or in commercial banks' foreign exchange deposits. But the reality is nothing shows up. Foreign exchange reserves and deposits haven't grown. Over 5 years, the total increase was just $187 billion. This is baffling and frankly disturbing. On top of that, this massive sum didn't leave China through foreign exchange transactions by the public either. The State Administration of Foreign Exchange tracks foreign exchange settlements and sales. When businesses or individuals sell foreign currency to banks, that's a settlement. When they buy, that's a sale for bank. The difference shows how much the banks are earning from foreign exchange. From 2020 to 2024, there was a net inflow of $533.7 billion. But in 2023 and 2024, the balance was negative, with a net outflow of $183.6 billion. In total, the banking system saw a net inflow of $350.1 billion over these 5 years. But even with this amount, the mystery remains. The increase in foreign exchange reserves and deposits was just $187 billion, which is much less than the $350.1 billion from settlements and sales. That means nearly half of this foreign exchange has disappeared. And that's just the $350 billion, not even accounting for the $3 trillion in trade surplus and the net investment inflow. The $3.2 trillion didn't leave China through other means either. It wasn't used to pay off foreign debt. In 2019, China's foreign currency debt was $1.33 trillion, and by September 2024, it had only dropped to $1.25 trillion, a minimal reduction of $80 billion. This figure is too small to matter. The only remaining option is that this money left China through financial markets. This is tracked by SAFE's Capital and Financial Account, which monitors foreign exchange flows through financial markets like stock and bond transactions. From 2020 to Q3 2024, there was a net outflow of $1.14 trillion, and by Q4 2024, the total net outflow could be $1.2 trillion. This outflow has likely played a role in fueling the US stock market's long bull run. But here's the kicker. Of the $3.2 trillion in trade surplus and net investment inflow, only $1.2 trillion left through the financial markets. So, $2 trillion is still unaccounted for. The foreign exchange reserves and commercial bank deposits only increased by $187 billion. And the foreign debt only dropped by $80 billion. Even with the outflow through financial markets, the numbers don't add up. Some people, particularly China's red economists, argue that most of the foreign exchange is hidden with the people, meaning it's kept by businesses or individuals. But this excuse doesn't hold water. As I've said, foreign exchange must either show up in the banking system or in the settlement and the sales data. But neither of these reflect trillion-dollar inflows. So the hidden with the people explanation is completely baseless. Now, let's make an educated guess. After subtracting the $1.2 trillion that left through financial markets, there is still a $2 trillion unaccounted for. The most likely explanation is that this money was siphoned off by China's top elites, who used the secret channels to move it abroad, hiding it in places like the Cayman Islands and the British Virgin Islands. These large-scale fund movements are nearly impossible for commercial banks to track or consolidate. The amounts are just too large. This creates a massive hole in China's financial data, a gap that can't be reconciled in macroeconomic figures. When it comes to the private dealings of China's red elite, nobody can stop it. It's a matter of national importance, and the secrecy surrounding these actions only adds to the mystery. Thank you so much for watching. If you find this video helpful, please like it, drop a comment below, and hit the subscribe button right here. It really helps YouTube suggest my video to others. I'll be back with more content soon. Until then, be well.